Hi, my name is Uncle Kevin. Welcome to my program. Today I have the privilege of interviewing Lesley Wilson-Jones. She's investment specialist from Rezco Asset Management. And if you haven't subscribed to my channel, please click on that subscription and click the notification bell to get my latest episode. So Lesley, it's a pleasure to have you here. It's the first time I have a guest coming to my office and then to do this kind of a recording. How are you doing?
I'm fantastic. Thank you, Kevin. Thank you so much for having me here today.
Oh,
this
great.
Should be good fun.
So, Lesley, let's first talk about you. Where are you from? How did you start in the industry and your career with Rezco?
Kevin, I'm a Durban girl, born and bred. I went to school there and then went on to varsity to do my BCom in economics and business management at Rhodes and Stellenbosch University. I then graduated and went into the working world, worked in the banks in London, came back, worked in the financial industry in Durban, most recently Nedbank Private Wealth, and then moved to Rezco a little over a year ago. So I've got my sort of honours in economics and my CFP, which has qualified me to do this role.
So tell us about Rezco. I started to get to know about Rezco, I would say about 7-8 years ago, when I saw that they were doing quite well in terms of long-term performance. And since then, I've attended quite a few webinars or seminars by Rob and other portfolio managers at Rezco. So who is Rezco and how did it all start?
Kevin, Rezco is a boutique asset management company and it's actually been around for a long time now, so way before 7 or 8 years. We've been around since 2004 as Rezco Asset Management as we know it, but it was actually founded just over 40 years ago in 1981
Wow.
by Wally Gray.
Okay.
Yes, and he started off by wanting to preserve capital and grow his clients' wealth. And he did this by using segregated portfolios. This then changed, and we've got a CIS license, a Collective Investment Schemes license. And in the early 2000s, we launched Rezco as you know it. In 2004, Rob Spaniard, our CEO and co-portfolio manager, joined Wally in the business. He's got a degree from UCT as well as he's a chartered accountant. He then worked as a portfolio manager for Momentum Wealth for a number of years before sort of taking over a private equity deal in which he looked after Sovereign Foods and became their CEO and actually grew the business. It was almost in liquidation and grew the business by 25% year on year for 15 years. Before then joining Rezco Asset Management to be the portfolio manager on our accounts and on our funds. Just over 10 billion in assets under management. So grown very, very nicely.
Is Wally still involved in the business?
Wally's not involved in the business anymore. He sits as a non-exec sort of chairman, so not in terms of the day-to-day, but Wally is the most passionate man you'll ever meet. So he's very much still involved in the team and the company from sort of just not in terms of management, but just oversight and being involved, as well as in the Rezco Foundation. Yes.
Rezco is unique in the way that I know most fund managers, asset managers, they are either based in Cape Town or maybe some of them in Joburg, but Rezco is based in Port Elizabeth or whatever's the new name, which I battle to pronounce.
Quebec.
Quebec, okay. So why PE?
And that is actually where Wally and Rob are both from. So, but we've got two distinctive offices. So we've actually got the most beautiful office, which I've just had the privilege of seeing in this trip, up in Sandton on West Street. And it overlooks the whole city. It's exquisite. So that's where all our analysts, as well as our other portfolio manager, Simon Sylvester, sit in that office in Sandton. And then Rob and some more of our kind of administrative team and accountants and that sit in the Port Elizabeth office. And Rob's sort of bounces between those and overseas and back and forth. So he's all over. He's got to be where he needs to be to manage things properly.
Tell us about Rezco's investment philosophy.
So Rezco's investment philosophy is all about looking for risk-adjusted returns. So the most important sort of aspect we focus on is protecting clients' capital. We do not want to put out too much risk for the amount of return that's out there. And we've got a fantastic track record of doing this. We've actually avoided the 2008-2009 crisis, the COVID crisis that we saw sort of in March, April last year, and a potential another one, which I'll talk to you a little bit further about coming along. But,
scary.
But it's all about the way that we allocate assets in between sort of the different asset classes, I suppose. So managing risk through asset allocation and the underlying stocks that we choose. Yeah.
Comes to an important point now, because if I look at Rezco's funds, and your more prominent fund certainly is the Rezco Value Trend Fund, which has been going on for many years.
Yes.
Then your award-winning Rezco Equity Fund, which has been doing well over the last 5 years or more. As an advisor, if I look at the recent performance of these two funds, it seems to be quite a divergence. Rezco Value Trend Fund was doing very well, then there's a bit of a bump along the way. And last year, it really did very well during that COVID market crash. But since then, it seems to be that the Rezco Value Trend Fund is going nowhere. It's like flat last 12 months, the negative return. Whereas your Rezco Equity Fund was one of the best equity funds, actually award-winning for the last 5 years' performance. So can you explain to us why such a divergence in your fund's performance, even though it's managed by the same people?
Certainly, Kevin. So as you know, there are different ASISA categories. As far as an equity fund goes, it has to be 90 to 95% invested at all times, which means invested in equities or risk assets as we know them. The other funds, the Value Trend Fund being one of them, they're multi-asset funds. So they have a different mandate and they are managed in a different way. So they don't have to be invested fully in equities at all the time. They can use other underlying assets. So things such as cash, money market, bonds, as well as equity and property. So when I said earlier, we look at risk-adjusted returns and managing clients' risk, we see the current economic environment as being exceptionally risky. So we are sitting particularly cautiously in the funds that we are able to asset allocate and not have to be fully invested. So the reason that we managed to avoid both the 2008-2009 great financial crisis as well as the COVID crisis was due to the way that we manage this asset allocation. And the reason for our recent underperformance is, again, for the way we've allocated the assets. And the reason for this is we saw a lot of risk during COVID times in the February, March last year. We saw what was happening in terms of COVID offshore in Asia, in China, and we thought this might not be contained in those markets. This could spread to the rest of the world. So we decided to sell out of all of our risk assets within these balanced or multi-asset funds and take all of the risk off the table and sit in cash. So when the market did crack, when it's kind of spread, the contagion spread to the rest of the world and the market cracked and the equity prices fell, we were very protected and we managed to protect our clients' capital and not lose it, where some of other managers and our peers lost a lot of money for their clients during this time. So the reason for our current underperformance is that we've maintained that position, and this is due to the risks that we've seen in the market since then. So for the last sort of year to 18 months, we've seen the COVID variants change. We were unsure about the vaccines. This then morphed into more of inflationary risks. Looking at what's happening over in the US markets, the amount of money that the Fed is printing, the bond repurchases that they're doing, the amount of stimulus, quantitative easing as we call it, as well as keeping interest rates at zero, we think it is substantially excessive. We don't think that that can continue into the long term, and we think that they're going to have to do something about it. And the reason I say this is all that money out there is chasing too few goods, which means that inflation comes through. And we can start seeing this month on month. The Fed or the Federal Reserve is targeting 2%, where for the last 4 or 5 months, it's been running at 5%, which is more than double that target level. And there's a lot of talk about whether this is transitory and whether it's going to come back down. We are not so sure. So we think that this inflation is going to run hotter for longer. And the Fed's going to have to intervene, increase interest rates, pull back on all the stimulus that they've been giving out, and this will cause a bit of a sort of taper tantrum as we know it before, which will be then a big risk or equity sell-off, and prices will drop again. So we've kind of sat on the cautious side and just aim at protecting capital. It has hurt us in the short term, but as we know, investing is not a short-term game, so you've got to look over the 5 or 10 year returns, and then our funds are still right up there with some of the best.
There are some people, rightly or wrongly, saying that because of inflation. That's why you need to hold inflation-beating assets such as equities. What's your view on that?
The problem is, so some of the equities now are excessively overpriced, and that is because there's so much money out there. So people sort of usual side-by-line guys sort of playing the equity market, so which is also a form of inflation. So they're pushing up these PE ratios, or the price of these equities, where if there is a big correction and there is a big sell-off, those people will lose a lot of money because they are risky assets, so they've got a lot of exposure to those. So our thought right now is we would rather sort of wait for things to correct. We think that prices can't get higher. So once there's a correction, we'll look at opportunity at buying back in at a lower price, and we will have the dry powder or the cash available to do so. Where people that are invested in equities, if they do crack, they're going to have to ride it out, and they'll lose a lot of money and hopefully make it up on the upside. But where we could make significant excess performance and out returns, yeah.
When investors invest in unit trusts, what are the things they should be thinking about?
Well, there's a lot of things they should be thinking about. So a big one in investing is time horizon. Are you investing for the short term or the long term? The longer term, the more risk you can take. The shorter term, obviously, the safer you need to be. If you need that money in an instant, you need to be able to take it out regardless of what the scenario is at the time. So time horizon is obviously a big one. Second there is the risk management. How much money do you need when? And is this money day-to-day living money, or is this for a holiday and something you can afford to take a little bit more risk? So those are two of the main things.
Just help our viewers out there. I know that you are not giving them advice, okay? But given the two funds, or out of the many funds you have, the Rezco Equity Fund and Rezco Value Trend Fund, which one should they look at?
Kevin, that kind of alludes a little bit to what we were just talking about in terms of risk management. So the Value Trend Fund is a Regulation 28 fund, which means that it's a more sort of conservative fund. Those funds, Reg 28 funds, are funds that can be used in retirement vehicles. So that offers a lot more protection than your pure equity fund does, which has to be 95% invested at all time. Yeah. So a Reg 28 fund would normally be combined with a number of other balanced funds, and it would be, for your pension funds, your provident funds, your RAs, and for kind of slightly more conservative investors. It's a very balanced approach, where your equity fund blends well if you want to make it a little bit more aggressive or a little bit more risky. If you've got a longer time horizon, you can include a little bit more equity into that. So you would almost use it as a bolt-on strategy, or as an advisor yourself, you would know sort of from a building block approach if you're doing your own asset allocation. But to go straight into an equity fund as a sort of individual investor, you're taking on quite a lot of risk, but there's obviously an opportunity to get a lot of return out of that. And as you say, that fund's done 75% over 5 years, about 55 over 3 years, and it's done 31% over the last year. So it's done very, very well. Yeah. But it is obviously you're taking a lot more risk.
Let's unpack the Rezco Equity Fund a bit.
Sure.
So I understand it's only investing in South African equities.
Yes.
What's the reason that it doesn't invest in offshore equities? Why is just focus on South African equities?
That is the mandate of the fund. So that fund's not allowed to invest in offshore equities. It has to invest in South African local equities. Some of them are dual listed, but that means they have to be listed here as well as overseas, and that's the only way they get their offshore exposure. But it's a mandate, and as far as the CISA category goes, so it can only invest in local funds.
That's the question I asked last week, and I'd like to ask you as well. If you look at the South African equity market, the JSE, there are only about 300 listed companies, and if you look at the number of shares that are actually available for buying for liquidity and market cap, and that really the choices are rather limited. Yes. Compared to offshore equities, where if you look at S&P 500 or if you look at New York Stock Exchange, the number of stocks listed in China, etc., then South Africa seems to be a small market and not much liquidity, and you have huge concentration risk. So given all these things, is Rezco still able to find opportunities and not restricted by the kind of liquidity concerns?
One of the advantages of Rezco being a boutique asset manager is that we're a lot smaller than some of the bigger names that we know out there. So we have 10 billion under management, which is far smaller, which makes us more nimble and agile and flexible. So we kind of bridge the gap between having the best of both worlds. We're not a very small management company. We're still about 40 or 50 people.
Yeah.
We've got significant investment in technology, a fantastic long-term track record going back to 2004, was where our Value Trend Fund was launched, and really good track record of performance as well as risk management, as well as the 9 awards that we've won. So from all of these things, it gives us a bit of credibility, but we are still small enough to be nimble and agile. So we can buy into sort of smaller positions where some of our bigger competitors, or peer group rather, aren't able to do so. So smaller cap, medium cap companies, we don't buy smaller caps typically. And then we also can take quite different positions. So actually one of the questions I often get asked is, why don't we hold NASPers? That's one of the sort of main shareholdings in most sort of asset managements. We don't hold them for ESG, which is environmental, social and governance reasons. So for the G, sort of the governance, we just say it's too complicated, so we don't want to hold it. As also with the way China has obviously changed some of the rules. There's certain, we take different stock pickings, and Rob's won many awards for some of the stock picking. Right back at university days, he actually won a stock picking award for, I think it was Financial Mail or something, best stock picker of the year. So he's got a great track record, and that translates into our equity fund as well.
I must say that's quite a contrarian position by Rezco. Like most fund managers, they will have at least some kind of weighting or holding in Naspers or process, the indirect investment into Tencent, and yet Rezco is on the other camp where you don't actually
always
touch
on the
that.
other camp.
Wow, that's unique. So right now, how does Rezco, and coming back to what you were warning me about, something coming up, how does Rezco see the investments landscape at the moment?
Kevin, quite funny that you bring up the word contrarian, because we're often seen as a contrarian asset manager, where we aren't contrarian for the sake of being contrarian. We are just a high conviction manager. So we believe in what we see out there, and maybe we see things a little bit differently to everybody else at times, as we have over this past year. So that often lends itself to people saying we're contrarian in terms of we're different. So currently our equity funds doing exceptionally well, invested very differently to everybody else, and our balanced funds or multi-asset funds haven't been doing so well because we obviously aren't invested and we have quite a different positioning to everybody else. This is also another reason why Rezco is fantastic to use in a client's portfolio, is because obviously we know everyone has ups and downs at certain times. So you blend things and diversify to sort of mitigate or reduce risk. So, when somebody's at rock bottom, there's only one way for them to go, and that's back up. But in all seriousness of the risks that we're seeing, we really do think that the US Federal Reserve is going to have to increase interest rates and pull back on all of this tapering to mitigate or to reduce this inflation. And that's going to have a big knock-on effect to the markets, which are very overpriced at the moment. And if equity markets do crack and there's a big drawdown, our clients' money will be protected. And I know that's maybe very different to what other managers are seeing at the moment. But again, we've got a fantastic track record of protecting capital and managing risk. So I'm not so sure. Do you think things are going to carry on going up and up forever?
Well, I think that my experience with the investment history is that when things go up or go up a lot, it's bound to come down sometime. So if you look at the long-term history, generally that the equities market, they go up. But if it goes up too much, it has to pull back some point in time. And I also think the market is expensive.
Yes.
It's just that I think that the Fed is trying to manage it, to try to not to have that quite a major correction.
Yes.
But we don't know how well they can manage, and also all the factors you talked about, like inflation and tapering, that what outcome we're going to get. Is going to be a kind of a sideways market for a few years, or is going to be another market crash, which is it's unlikely from the history point of view. If you look at the market history, just about every 10 years you might have a big crash, like way back in 2008 and last year. And so to have so many big crashes in a short period of time is unlikely. It is difficult to, no one knows.
Also depends on the sort of fundamentals of the crash, though.
Yeah.
So sort of 2008, 2009 was based on the way the financial system was being run. Last year was kind of fluke out of the nowhere. It was a virus, and things recovered almost too quickly, some might say. So maybe we do another financial correction. As you say, markets are very, very expensive at the moment, and can things just carry on going up and up forever? Especially if the reason for it going up and up forever is just printing money. We all know how that ends. So we're anticipating quite a big correction, and to kind of normalize things, which I know is not what everyone wants to hear and what we need, but we would offer protection should that happen.
Lesley, thanks so much for your time to share the insights from Rezco. Until next time, bye.
Thank you so much, Kevin. Thank you for this opportunity.
Thanks for watching. Thumbs up if you like this episode and share it with your friends.